Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. Stocks rising as the latest read on inflation shows consumer prices ticking up in August, and jobless claims rose to their highest level in nearly 4 years. We're looking at how that could impact a Fed rate cut decision. Right now, there's just an hour to go until the closing bell on stocks. They're higher. The Dow's up about 580 points. The S&P 500, your broad gauge, is up about 0.8%. The tech-heavy NASDAQ is up about 0.7%. Let's welcome in now Fed correspondent Jennifer Schonberger and data and markets editor Jared Blickery to break down all the headlines. Jared, my friend, we will start with you on the trading action so far.
We got a nice rally on our hands. We got the Dow, NASDAQ, and S&P 500 hitting record intraday highs here. And you can see most of the action in the day was made early on here. And we've just been holding very steadily near these highs in the Dow all day long. And as you said, more than 500 points, actually approaching 600 points for the Dow. And here's the NASDAQ composite, similar situation, hugging the highs all afternoon long. And the S&P 500, same case there, it's up 0.8%. And we can even go to the small caps, which have been lagging recently. Russell 2000 up even more than the Dow, 1.44%. And you take a look at what's happening in the bond market. We have seen this steady march lower in yields. Now down, the 10-year actually hit 4.0%. It's off a little bit of that, so it's about 4.02% right now. 30-year down 2 basis points. That is trading at 4.65%, and the U.S. dollar just a little bit weaker as well. All of this coming on the back of that inflation report that we got this morning. A little bit higher on the headline number. We're going to be talking about that. But check out the sector action. We got XLY, that's consumer discretionary. Tesla, the biggest gainer there in terms of market cap, up almost 2%. Right behind it is materials. Then we got healthcare, and then communication services, real estate, financials, all of those up more than 1%. You can throw staples in there too. All of those outperforming as well. Only one sector in the red today, that it would be energy. And let's take a quick peek at the NASDAQ 100. We see a lot of outsized performers. We already talked about Tesla real quickly. Alphabet up 1%, Apple up more than 1% after being down yesterday. And a lot of the strength we're seeing is, some of the strength I should say, is in certain semiconductor and certain software names. Micron up 8%, Lam Research up 7%. If we look inside the software field, we get CrowdStrike up 2, HubSpot up 2, so is Shopify. Oracle, after that huge day yesterday, adding several hundred billion to its market cap, that is down 5.8%. But let me skip over to the Dow. We don't have a lot of red here, and it's just this broad mix of broad bullishness. And it's not just the consumer-facing stocks like Home Depot and Procter & Gamble. It's also the healthcare stocks. You got United Health up 2%. And even China, which is often uncorrelated with U.S. markets, you see a lot of green here. BABA, the biggest of this bunch, up over 7%, almost 8% right there. And then I was also checking out some of the meme stocks, and let me just sort this by performance so we can see Opendoor up 69%, Circle up 15%, iRobot at 8%. It just seems like there's a lot of, I don't want to call it froth, but there's a lot of exuberance in this market. Maybe it's on the prospect of those lower rates that we're going to see next week with the Fed, but not to get too ahead of ourselves. Let's maybe get some color on that from someone else.
Let's do that, Jared. Now to Washington, all eyes remain on the Fed's next move. Jen, bring us up to date here. What is the latest?
Hey there, Josh. Yeah, a stickier inflation report today, unlikely to kick the Fed off course for an interest rate cut next week, but it could prevent the Fed from cutting by a jumbo 50 basis points. The consumer price index on a core basis, which excludes volatile food and energy prices, showed prices rose 3.1% for the month of August, so holding the same level as July. And price increases holding there as we saw core goods prices increase as well as services. So inflation remains stubborn, and we are seeing tariffs put upward pressure on goods prices. All this coming as a report on wholesale prices for the month of August, which came out yesterday, actually showed that firms are not passing on increases from tariffs to consumers. If that continues, that could keep a lid on inflation. But we also saw today a jump in jobless claims to the highest level in 4 years. I was talking with former Kansas City Fed President Esther George earlier today, and she was telling me that today's Consumer Price Index report leads her to believe that perhaps inflation may be stalling around these levels of 3%. While we haven't exactly experienced a burst upwards from inflation from tariffs, there is underlying momentum in inflation, and that concerns her and is something that could be carried out through the forecasts. But remember, the Fed needs to balance both sides of its dual mandate. And while we are seeing stickier inflation, the job side of the equation looks like it is weakening. Again, we did see that jump in jobless claims today to the highest level in 4 years, and that follows weakness from monthly labor market reports, which have been weakening for the past 3 months. And it is for that reason that many investors and many former Fed officials I've been talking to expect the Fed to cut by 25 basis points next Wednesday. Perhaps the bigger question is how many cuts could be penciled in for the rest of the year? And Esther George telling me in that same conversation earlier today that perhaps we could see a dovish tilt to interest rate projections, as so-called dot plot, because we know that Fed Governors Mickey Bowman and Chris Waller have been dovish. They want to see more rate cuts. If we see Donald Trump's nominee to the Federal Reserve, Stephen Myron, confirmed in time, which is what we expect, he has also been a dovish voice, and so that he can also contribute to that. And there are also other voices around the table who have said they are concerned about the labor market, including San Francisco Fed President Mary Daly. Josh?
All right, Jen, Jared, thank you both so much. Well, for more on what a sticky inflation report and labor market weakness signals for the economy and markets, let's welcome in now Deutsche Bank senior U.S. economist Brett Ryan, along with Timothy Chubb, CIO at Gerard, a Univest Wealth Division. Guys, welcome to you both. Brett, I'll start with you and the data we got this morning. Brett, bottom line, economists saying it seems we've got sticky inflation on the one hand, at the same time, a weakening labor market. Brett, what did you make of the data? What do you think the Fed makes of the data?
Sure, Josh. I'll start with the labor market data because I think it's an important point that the spike in initial claims was due to Texas, the state of Texas. Unclear exactly what drove that spike. It could have been a response to recent flooding. There was a deadline for applications for claims there. So I think we need to see another couple of months of data before getting too concerned about that one. We got the benchmark revisions earlier this week, and they were larger than anticipated, but they also show a very steady low level of net job gains. So it's been more of the same rather than a significant downshift over the last several months. And then on the inflation data today, yes, the headline and core were in line with expectations. You have a mixed bag in terms of tariff exposed sectors. So you had inflation coming off for household furnishings and appliances, but you had a pickup in apparel prices, and you had a jump in TV prices, actually. That was the largest since the pandemic, 2.7%. You also had a pickup in jewelry. Jewelry actually had an all-time large increase of almost 6%. And then also on the services side, you had OER pick up a little bit. Airfares were also picked up meaningfully. That was a large increase, starting to retrace the drop that we saw from May to the middle of the summer. And then lodging away from home was another contributor there. But when we add up the pieces from the PPI and the CPI, it actually points to a slightly less than expected core PCE deflator, which is the Fed's preferred inflation metric. So if you get a 0.2 on the August core inflation number for the Fed, that helps with the story in terms of easing by 25 basis points next week and potentially penciling in another 25 basis point cut to what is already 50 in the summary of economic projections.
We did, Brett, have some economists on the show who said they didn't think 50, a jumbo-size cut next week, was off the table. But what do you think? Do you think the inflation stats take that off the table?
No, I don't think the inflation data today warranted a jump to 50. The situation relative to last year, you have to remember last year at this time, you had the unemployment rate tick up about 40, 50 basis points over a 6-month period as job gains were decelerating. And that was causing a lot of concern. The inflation data today was more in line. It points to when you look at the Fed's summary of economic projections from June, they had penciled in 3.1% core PCE inflation Q4 over Q4. today's data, you could argue maybe that gets downgraded a tenth, but it's also, you can easily argue they keep it unchanged at 3.1%.
Tim, I want to bring you in here as well and get your take on the data this morning, because you're looking at through a different prism, Tim, as a CIO. So what do you make of it?
Yeah, I mean, just going back to the earlier comments, not an economist, I'm an investor, but this definitely feels like a jobs recession. Obviously, payroll, employment declined in June, held up a little bit better in July and August, but these increases were at the margin, and they seem like they might be likely to be revised away. And so, I think the jobs over inflation narrative, continues to prevail, following the data this morning. And ultimately the Fed, as we'll get more color on next week, is I think going to be in a position that they've decided where, spiraling unemployment is a greater risk than spiraling prices. And so, I think the sort of the release valve today that we're seeing, really flow through into equity prices is, really the impact of the long end. And, these levels really can't be understated if they continue to hold. Really broad implications of the 10-year for consumer financing, mortgages, and other loans. And so I think the lowest level, the 10-year this year, is around 386. So there could be some runway there, headed into 2026.
Brett, can I also get your take on the broader economy? I mean, could you see a situation, Brett, in which, okay, you have a labor market that's cooling, that's weakening, but the broader economy hangs in there?
Yeah, definitely. And the question, one of the biggest questions the Fed's going to have to grapple with over the coming months is how much of the labor slowdown that we're seeing, is this due to supply versus demand factors? And when you look back at what the JOLTS survey has been telling you, it's been a low hiring, low labor demand, as Yes pointed out, and low firing environment really for 12 to 16 months now. And to the extent that you have a crackdown on immigration, how much is that restricting job growth? The CBO came out today and lowered its net immigration number by 1.4 million. So that's going to impact the pace of job gains that you need for break-even employment is lower than what you would normally expect. So if we had thought that break-even payroll gains of 100,000 were enough to keep the unemployment rate steady, it's likely closer to 50,000 at this point.
Tim, I want to switch gears a bit. Just on a day like today, Tim, where again we just have green everywhere. What happened with the warnings of negative seasonality, Tim? We had plenty of smart folks warning me about that. I mean, is that rearview mirror? Could that still be on the way? I'm just curious on a day like today how you're thinking about that.
Yeah, it could be. I think ultimately the report this morning and also the revisions that we saw in the labor market last week really, took some of the risks out that we would see, yields spiking and also, the economy and labor market continuing to soften. And so I think it's ultimately a bad news is good news situation for stocks. And, being that we've seen some chop underneath the surface, starting to see some of these companies that are going to be more rate sensitive start to broaden out in breadth, definitely concerning to see some of the froth within a lot of the meme stocks. But at the end of the day, look at the Russell 2000, as you just said and reported on. So much of that index is now unprofitable, and that number has only continued to grow as it's become more and more oriented towards biotech companies that are really relying upon the capital markets, the finance R&D endeavors. And so I think going back to the comments I made earlier about the 10-year, seeing the long end move down like this is definitely I think going to be a bit more of a tailwind than the seasonality effects as headwinds.
Tim, Brett, great to have both you guys on the show today. Thanks so much.
Great, thanks Josh.
We are just getting started here on Market Domination. Coming right up, the C-suite opening the door to new leadership for a popular real estate platform. to tell you what you need to know about the move. Plus, Paramount Skydance reportedly preparing for a bid to buy Warner Brothers. We'll tell you everything you need to know on that one as well. And stablecoin lender Figure makes its Wall Street debut. We're watching what the moves and the stocks are making. That story and a whole lot more coming up. Stick with us. Opendoor announcing a leadership change, a new CEO. It's named all former Shopify executive to the post, and the stock soaring. Joining us to discuss if this will spark more investor optimism, we got Derek Horstmeyer, Costello College of Business at George Mason University, professor of finance. Derek, welcome. So the stock, it's on the move, Derek. They name a new CEO. They do reappoint co-founders of the board, including, we should mention, I mean, there's some heavyweights. Keith Rabois, that is a big name, but we know fundamentals challenged here. Derek, what do you make of it?
Yeah, I think this is obviously a strong move for them. Investors hate uncertainty, and there's been some uncertainty hanging over this stock for a while now. This move to appoint, the former COO of Shopify is a strong move. It aligns with kind of the move into AI, which he is an expert at, and obviously the retail investors as well as institutional investors are looking favorably upon this one.
There are challenges here, Derek. I mean, just to put a fine point on the numbers, Barron's has a nice summary for us. Opendoor has never posted a net profit over a fiscal year. If you just look at the top line, revenue projected total looks like about $4 billion this year. That would be down from nearly $16 billion in 2022. I mean, can they pull this off, do you think? How much confidence would you have that they could turn this around?
Well, I think it's a hard turnaround story, right? The stock was on a tear, came absolutely down, 80+%. He has his work cut out for him, but I think it is the correct move to try and incorporate AI and make a pivot to turn the story around. It might be a little bit cost intensive, capital intensive, but it probably is the right move for a stock that's been suffering this much.
Let's say, Derek, I was one of your students there, and I said, this Opendoor story, I think it's something there. It's compelling. I'm going to take a flyer on it. What would you tell me?
Well, I would still be hesitant. We have seen the initial pop, up quite a bit over the past few days. But there's a lot of headwinds. So it's a little bit like buying a lottery ticket, I think, at this point. If he can turn this around and get it upwards of a $20 or $30, $40 stock again, I think that would be quite impressive. But there is some lottery-like returns here.
Does it tell us anything, Derek, the moves in this stock, about the broader market? I mean, when you look at this, do you think it's fun? Do you think it's concerning? What do you make of it?
Yeah, I mean, I see the reemergence. Anytime we see a reemergence of meme stocks, it's a little bit concerning, right? We've seen some really frothy IPOs recently. We've seen an uptick in meme stocks like Opendoor in the retail space. This is all the chatter on Wall Street bets. Whenever we see this, it is concerning, right? Because we're losing market efficiency. We're kind of losing a handle on what are fundamentals. And even though this is good news for Opendoor, right, it is a departure from fundamentals, I guess you would say.
Is this this is just a new trend, though, a new theme, Derek, for a host of different reasons? That's part of the modern market story, though, that we have, in this case, the so-called, I think they call themselves the Open Army. It's a group of retail investors. They get together, they crowd together, they get Opendoor on the map, on the radar, and they force meaningful changes at the C-suite for a host of different reasons, generational, technological. Is this just going to be a continuing story we're going to watch? If not Opendoor, some other name?
Yeah, what meme stocks have shown us is if you get enough retail investors together, and now they're pairing with hedge funds. If you get a few hedge fund well-known people and a large retail army behind you, you can really move stocks. You can go against the short positions, and we've seen this momentum hit stocks like Opendoor. Obviously, GameStop was the original. It plays out, every few months, and it's an interesting new phenomenon in how markets work.
All right, Derek, thank you so much for your time today. Appreciate it.
Thank you, Josh.
Now time for some of today's trending tickers, taking a look at Warner Brothers Discovery, Alibaba, and Duolingo. Let's start here with Warner Brothers Discovery. Those shares surging as Paramount Skydance reportedly prepares a majority cash bid for the company. According to the Wall Street Journal, the bid will be for the entire company, including its cable networks and movie studio. This comes after a few weeks after Skydance, run by David Ellison, son of billionaire Larry Ellison, closed its deal to merge with Paramount. Turning to Alibaba, those shares rising as the company plans to raise $3.2 billion through the sale of a zero-coupon convertible bond. According to Reuters, the bond will be the largest of its kind this year. The Chinese e-commerce company is saying it will use the net proceeds for general corporate purposes. The allocation will include about 80% directed towards enhancing its cloud infrastructure. And lastly, Duolingo shares, they're gaining as Citizens JMP highlights a bullish picture for that stock. The firm noting that Duolingo could be a big beneficiary from Apple's recent changes to U.S. App Store rules. Change will allow developers to steer users to alternate methods of paying for services or subscriptions offered in the App Store. Citizens JMP expecting apps like Duolingo to unlock meaningful cost benefits. Well, coming up, are all IPOs created equal? We're comparing IPO day prices on recently public companies. Stay with us, then want to see these moves. Figure Technology Solutions, the latest company to IPO in a long list of hot public debuts so far this year. The IPO market showing new signs of life with blistering stock pops on day one from companies like Circle, Figma, and CoreWeave. Here with a closer look at the IPO market optimism is Yahoo Finance's Jared Blickery. Jared.
We got another one today. You can see Figure is up 21% from its IPO price, and about 12:38 p.m. it finally opened up at $36, and it IPO'd yesterday evening at $25. So that's a 44% pop. But most investors don't get in at the IPO price. They have to buy after it opens. If you're paying attention here, it's been down most of the day here. So most investors who bought today are not making money. In fact, they'd be losing a little bit of money. And so what I wanted to do was compare. I took all the IPOs of the year, found the biggest ones, and I sorted by those opening pops here. So this is the white bars is a percentage of the IPO price to the opening price. And number 1 and 2 are Bullish and Figma. Each of those were about 160%. So that's the white bar. Then the green bar is what happened from the open to the close. And you can see Bullish Group, well, they lost a bit of money there from the open to the close. Figma managed to gain. So not only did they get that pop on the open, they also got another pop into the close. Then you got Circle, then you got Chime here, then Firefly Aerospace, and then you have Figure. And we don't know what the close is going to be just yet, but here we have this 44% pop represented by the white bar. And if we were to draw in the green bar based on what's happening right now, it would be just in line with Firefly and Chime, each of those down about 14%. Finally, here we have Klarna, which isn't that different a situation than Figure or Firefly or Chime. So that is what's happened this year, but I wanted to go back a little farther, and this chart right here goes back a decade, and it shows the deal volume of IPOs by quarter. And so you can see what stands out is this huge spike here. That was a pandemic. That was the era of free money, large ass monetary-wise and also fiscal-wise. And then we had that 22 crash, and there was virtually no IPO activity here. It's been trending slowly up, kind of stair-stepping up here, and we're doing about $13-15 billion a quarter, and we still have a few weeks left in this quarter, so we'll have to see what happens. But nevertheless, the IPO market is coming back, and we've seen a number of big pops, and that's actually a good sign for liquidity and the capital markets in general. Back to you, Josh.
All right, thank you, Jared. Well, stablecoin lender Figure Technology Solutions makes its IPO debut at the NASDAQ Thursday. Executive editor Brian Sozzi spoke with the now public firm's CEO.
Look, I think investors are very intrigued by your story. When you, in the lead up to this debut, Mike, what did you hear from investors? Because I'm getting indications that this might open around $34. It priced above the range. Clearly, where investors were excited about something in your business model, or many things.
Yeah, I think Figure is using blockchain technology to transform capital markets, and we've proven to be very effective at doing that in the credit domain. Over $17 billion of originations on public blockchain, over $55 billion of transactions. And I think the market resonated to the product market fit with blockchain, but also the financials. Obviously doing $340 million in revenue and over $100 million in EBITDA last year, being GAAP profitable and growing at the pace at which we're growing. There was a lot of enthusiasm there. So we were excited about the market reaction and excited to get this IPO done.
In its simplest form, Mike, I think a lot of the average investors that are on Yahoo Finance, they will read the prospectus, they will slightly understand what you do and how you do it. But for those that don't get it, because it is a little bit of a complicated business, how should they think about the Figure model? What do you do?
Sure. The beauty of blockchain is it allows you to displace trust with truth, and that allows you to change how markets trade, how they're financed. So, if you think of something like the stock market as an easy example, 7 parties sit in between buyers and sellers of every transaction. Blockchain has the ability to distill that down just to 2. Every time we swipe a debit card, 5 parties sit in between the buyer and seller. Blockchain can distill that down to 2. So when you disintermediate those actors, you're freeing up trillions of dollars of market capitalization. And I think that's why the market's excited. But it's not just the disruption of existing businesses, it's the greenfield opportunity as well. Blockchain allows you to create new markets that didn't exist, very much like what we've done in private credit, where we've created a liquid private credit marketplace for both the trading and financing of assets in a market that didn't exist before and really could only be done with blockchain.
That is a large slug of money that you raised, Mike, almost $800 million. Where will some of that go? What technology are you going to put that money towards?
Sure. And look, I mean, in our last company, we did $1 billion raise from SoftBank. It was the largest private company raise ever done. And we used that balance sheet as a weapon to be able to take risks that our competitors couldn't. I think that's perfectly analogous here. I think having that balance sheet is going to allow us to lean in and really push disruptive blockchain use cases in a way that not having that capital would be difficult.
Is this the perfect environment for stablecoins? Curious your take on how the regulatory environment has changed this year, even compared to when we talked a couple months ago.
Yeah, I think on a first order basis, obviously the Genius Act is hugely beneficial for the stablecoin industry. The second order effect of the stablecoin aspect, especially as money flows into treasuries out of bank deposits, introduces a tremendous opportunity for decentralized finance, which is really at its core what blockchain's for. And so, we're excited to be a leader in the DeFi side and really, leaning in and looking forward to how that market evolves over the next year.
I hope I got this right. Are you using OpenAI to approve mortgage loans? How does that work?
No, we use a lot of AI through our process, but we tend to underwrite in a very boring way. What we do is we don't use humans. And so by taking people out of the process, we have over 170 third parties that use our technology to originate assets on chain. And they all do it the exact same way. That homogeneity of those assets, coupled with the certainty of blockchains, allowed us to bring liquidity into that market where, again, it never existed.
What are you seeing in the housing market?
Look, I think obviously rates are beginning to come down. That's beneficial. That's great for all lenders, including ourselves. Reduces debt burden, reduces DTI considerations. But how far it goes, I'm not sure we're going to retest those lows of COVID. And so I think the folks that are in 2% mortgages are still going to hold on to those mortgages, and that's great for a home equity line of credit and second lien. But over 20% of our volume now is first lien mortgage, and we expect that to continue to expand, especially as rates fall.
Is it right to think you could be sitting on a very profitable year next year once rate cuts do start to flow in and the housing market hits some new gear that hasn't been in for a couple of years?
Yeah, look, I think there's certainly some macro catalysts out there, some tailwinds around the market, the interest rate environment. I also think, what you'll see from us over the coming years is coming next 12 months is expanding the blockchain application into other asset classes. So just as we've been able to use it for private credit, we think it's equally applicable in equities and commodities and currencies. And so, we look forward to leaning into those asset classes and driving new innovative use cases.
Is the stock market just outdated? Mike, I see what you're doing. It's fascinating technology, but I look at the New York Stock Exchange, even the NASDAQ. I mean, they're phenomenal companies, entities, but I see what you're doing, and I just think the whole game is about to change in a big way.
I think we're right on the cusp. I think if you looked at how much we accomplished over the last 4 years in a very, very difficult regulatory environment, and the environment that we now have with a different SEC and with an administration that's supportive of the technology, I think an enormous number of things are going to happen. It's sort of the proverbial slow and then all at once. And I think we're really at a tipping point. I think blockchain is going to be responsible for moving more public market cap than any technology has ever done before and probably ever will after.
I think about the business you created over at SoFi, Mike. Now you're out here with Figure. Clearly you have a passion for I wouldn't say personal finance. Maybe I should. What has driven you to spend so much of your career and so much of your time in this industry?
Yeah, so I'm very passionate around connecting sources and uses of capital. If you go back to when we started SoFi, that was the thesis behind it. We take alumni to invest in loans from students from their schools and have an affinity bond, and where both parties could improve versus the bank as a capital allocator. And with SoFi, we were a victim of our own success. The loans became so popular, we just relied on the wholesale capital markets to finance them. Figure gave me a second shot at this with blockchain and with DeFi. And so we're very excited about standing up a platform we have called Democratized Prime, where we connect sources and uses of capital and really disintermediating traditional capital allocators and letting individuals make their own lending decisions. And I think that ultimately is where the world's going to go to. I think with the stablecoin bill, the Genius Act, the second order consideration, again, is with all that money flowing into treasuries, it's coming at the expense of bank liabilities. That's going to force some kind of alternative way to look at credit. And I think decentralized finance is that way.
Shares of Oracle taking a hit today, but the software company is enjoying a monster run since its first quarter earnings report and the reported $300 billion cloud deal with OpenAI. For a deeper dive into Oracle, let's bring in now Cory Johnson, Chief Market Strategist at Epistrophy Capital Research and host of the Drill Down podcast. Cory, my friend, always great to see you. So listen, all right, Oracle's in the red today, but it's after this just remarkable move yesterday. Yeah. You have been pounding the table on Oracle, Cory. So first, I just want your take.
True fact.
What did you make of the earnings report you saw there, and what did you make of the investor response and reaction?
But before I lose myself again, I want to be clear. I'm biased here. I own the shares in Oracle. I've owned them for a couple of years now. I've worked with the company in the past. I hope to work with them again. I like some of the people there. So I'm totally biased. And everybody watching this should understand that I can't see this thing as clearly as I do other things, perhaps. But we saw an amazing quarter from this company, the likes of which we've rarely ever seen from any company. I can't think of anything I've ever seen at this scale that was so ginormous of an upside surprise, not to the numbers of the movement of the stock, but the change in the scope of a very, very large business. The only thing I've ever seen like this is NVIDIA about 2 years ago. It was really an amazing thing to watch. And it was, in this case, it wasn't orders, or it wasn't at least numbers that we saw in terms of bookings on the balance sheet. It wasn't, or certainly not the revenues they recorded, although the quarter was very strong. It really is that RPO number, those remaining performance obligations, that the orders that they have in hand were just jaw-dropping in their size on the heels of another quarter where I would have said the same thing, but this is just orders of magnitude bigger.
I want to take a beat here, Cory, because folks who are listening, not everybody might fully understand what Oracle does, appreciate what Oracle does, which is understandable. As a shareholder, as a believer, why don't we take a beat here for a moment, Cory? Just walk us through, what does Oracle do? How do they make money? And how has the company evolved?
It's a great question, because it really has been changing for at least 10 years. And I think that the company has talked about a lot. There have been a lot of skeptics. I've been one of them over the years when they've talked about moving from licensed software to the cloud in the face of a lot of attention that their competitor Salesforce was getting. And there were criticisms saying, well, is this really cloud revenues? Are they really lumping all this stuff in here? Where are they truly embracing distributed software? And what we can see now over time is that they've embraced that as much as anyone has ever done this. So their cloud business is fantastic. And their cloud business has different aspects to it. So yes, it is software and software delivered as a service. It's also infrastructure. That is the use of data centers. Infrastructure as a service is a huge business for them, and the thing that is growing so fantastically. There you have this wonderful graphic showing us they had $3.3 billion in infrastructure as a service revenues, in addition to software as a service revenues of $3.8 billion. And that is a change in the way that they used to manage software. But the software business that has been core to Oracle since its earliest days in the 70s, yes, the 70s, is now taking a back seat in terms of attention and certainly in growth to what they're doing with infrastructure, what they're doing in building data centers, where this is a company that is, yes, they've got a hardware business and they've trimmed that to make sure they've got the right offerings, which is a very small business, but the renting out and the construction of data centers is just been an incredible business for them that they have fully embraced to the point where one could argue they're right up there among the leaders there of building out these data centers for their customers.
Let me ask you, Cory, that great cloud computing fight, we talk about Amazon and Microsoft and Google. Where now is Oracle in that fight, now and looking ahead?
We'll see over time. There's different market studies out there. They're certainly playing catch up to the likes of Amazon Web Services and Microsoft Azure and Google Cloud Services. But they're clearly a contender here in this business. And what they're doing that's so much different is they really are building out data centers in an aggressive style and with a kind of a modular approach. This is something Larry Ellison has backed away from kind of larger management of the company and taken this role of founder of the company as chief technical officer, has really talked a lot in the conference call about the modular nature of their data centers in two ways. One is that regardless of the size, small or big, in the data center they're constructing, they are all running the same kinds of stuff so that a customer can go from a small data center to a big data center and find what they need in Oracle's offerings, or Oracle can build it for them. Then secondarily, they're reducing the size of all of the Oracle offerings so that it can be really all held on a singular rack or a singular set of components that will allow customers to get the same plug-and-play experience in any Oracle data center, including all of the Oracle data products, to allow Oracle to sell everything they have on a software standpoint to anyone using any Oracle data center and on any service, whether it's at an Amazon data center or at a Google Cloud data center. They've really homogenized across all of these offerings.
Let me ask you, Cory, we talk a lot about the success and who gets credit for that. We, of course, mentioned Larry Ellison. How much credit, again, as a shareholder, as an investor, would you also give to CEO Safra Catz?
Yeah, I mean, Safra Catz is, Larry gets so much attention. He's such an entertaining character, and he'll say just about anything. That any chance I get to talk to Larry or quote Larry, I just love it. But Safra Catz is the power at this company. She is the CEO of this company. She took over. She wasn't a co-CEO, but she and Mark Hurd were CEOs at the same time. Mark Hurd, the late Mark Hurd, passed away a few years back, and Safra has been running this company on her own and in a very powerful way. There's a very interesting style about her where she is firmly grounded in the numbers and really understands so much great detail about all the things that makes this very big and very fast-changing company run. And she deserves all the credit here. She's one of the most powerful women in business. She's a self-made billionaire. She's a really, really impressive story. She's a really impressive person to talk to. And she's very funny also. But she's a brilliant person that I think doesn't get all the attention that, and maybe by design, that other CEOs and other women who are leaders in business might otherwise. I mean, she's one of the most powerful women in the history of business in the world ever. She deserves a lot of credit here.
Cory, we're always lucky to have you on the show. Thank you, my friend.
Good to see you.
Coming up, saving for retirement, maybe taking a very risk-off approach. We'll have more on that when we return. Stick with us. As interest in alternatives like private equity and real assets heats up, many 401k investors remain unusually cautious, sticking to traditional stocks and bonds, even though private assets are becoming a louder part of the conversation. For more on this, let's get to senior columnist Cory. Cory.
Yeah, actually, it was pretty interesting because there has been a lot of talk about private assets. And what we saw in August was that investors actually had a bit of jitters about this and were very quietly, this is a report I saw from Alight, we looked into that very quietly shifting from large company and small company equities into the more conservative bonds, and to a lesser extent money market accounts, very on the low key, but there was definitely this quiet shift. I mean, there were no above normal trading days in 401k accounts. It was very subtle, but there was definitely this undertone of let's be a little more cautious here, Josh. So that was fairly interesting.
And Cory, what kind of inflows and outflows are we seeing here?
Yeah, I mean, there were not huge amounts, but it was clearly this transition. We saw the movement from equities into these more conservative fixed income funds. But what you and I have talked about, these private assets are really getting up a lot of attention. And recently there was a report that was out from Schroeder that showed that like nearly half of 401k investors said, hey, as soon as these private assets are in our plans. We really want to invest in these. And in fact, 3 and 4 said, we're going to even invest, up our contributions to our 401k plan so that we can invest in these. And this disconnect is quite interesting, because if they're getting jitters now about risk and not taking risk, I wonder, and it poses the question, are, what you say and what you actually do when these riskier private assets do hit retirement account plans, probably mid-year next year, when I know that Goldman Sachs and T. Rowe Price are expecting to have their target date up and rolling. Will they do that? Are they going to go for these, or will they not have the stomach for them?
All right. Thank you, Carrie. Appreciate it.
Thanks, Josh.
Well, the Fed is widely expected to cut rates at its September meeting, and while the stock market climbs on rate cut hopes, we're connecting the thread on what this all means for the options market. Jim Struber, Kineo Capital Managing Partner, joins us with a closer look in the options playbook, sponsored by Tasty Trade. Jim, it's good to see you. So, big picture, Jim, stocks keep working, hitting records. At the same time, next week, we think the Fed's going to cut, Jim. Maybe some economists telling me even a jumbo cut could be on the table given this weakening labor market. How should we think about capturing that risk in an options trade, Jim?
Well, broadly speaking, it does look like we're about to begin a sustained easing cycle. So for starters, it's worth sort of framing that 25 basis point rate cut next week. Very likely, yes, there is some chatter about 50. I don't expect to see that. And then according to the Fed Fund futures market, we will see 4 consecutive cuts into January and another 50 bips total later in 2026. So we're talking about potentially over the next 12 months, a total of 150 bips of easing, and then tying that back into the listed option market and volatility. The option market seems pretty calm about this setup. If you look at, for example, term structure, so 1 month, 3 month differential and implied volatility, right now that's flatter than it is historically going into FOMC meetings, meaning the embedded volatility 3 months out relative today is fairly low. And if you just look at the meeting on September 17th, next Wednesday, and the SPY straddle, it's pricing about a 1.1% move from now until the end of Wednesday, which is towards the upper end of the range of FOMC meetings, but not extraordinarily so. So the market looks to be saying that there's not a whole lot of uncertainty coming into this first rate cut of what might be several heading into 2026.
To your point, Jim, the VIX is below 15, so that is near the lows of the year. So folks don't seem to be too worried. Should we be buying, downside protection on the SPX?
Well, we're not. So if you look back historically at S&P performance following the first rate cut of a sustained cycle, when there are no recessions, over the next 12 months, the S&P 500 is up on average about 15%. If there is a recession, of course, it's a different story. In that scenario, the average performance of the S&P 500 is down around 8%. At our firm, we're pretty constructive. You talked in your last segment about Oracle and spending on AI and infrastructure. We run an energy and AI infrastructure fund. The Mag 7 are going to spend about $400 billion this year. If some NVIDIA numbers are believable, that can be sustained at a CAGR of around 20% over the next 5-6 years. You guys talked about Oracle just a few minutes ago. That's a wonderful example of that. In the second quarter of this year, spending on AI infrastructure accounted for about a third of the 3.3% real growth in the United States of America. So you've got solid underpinnings, even though the labor market looks like it's a bit shaky, especially after that benchmark revision lower earlier this week. So for us, underpinnings of economy, pretty solid. Labor market questions are out there, but here we come with the Fed into sustained rate cuts. So for us, it's a pretty constructive environment looking forward for equities.
What's a specific trade in AI, Jim, you could highlight for us?
So one we like that's playing home builders, not AI, is XHB out to January, just buying some upside via something like a 130, 145 call spread. And then in the AI space, again, this is a little bit more of a risky trade. But earlier this week, NBIS announced a deal with Microsoft. Microsoft's going to pay them $18 billion over the next 5 years. NBIS is an AI cloud provider. This whole space, we think, is very interesting. One name that hasn't moved a whole lot is called BitDeer, BTDR, Singapore-based Bitcoin miner that, like many of these names, are transitioning into high-performance compute. As I said, has not caught quite the bid of some of these other companies. So it is a name we like, and the way we would get exposure to that is, again, going out to January, buying something like a 20-30 call spread that costs about $1, gives you about a 9-to-1 payoff with BTDR 30 or higher at expiration. And for people digging into this HPC space, there are other names in here that, in our view, still look relatively undiscovered. When you think about scarcity, you think about data centers, you need land, you need power, you need fiber, and many of these companies have locked them up long ago because they were in the Bitcoin mining space, and now they're transitioning over. So it's a very nice, relatively speculative space to be watching very closely into year end, giving this the underpinnings of the easing that the market expects at this point.
Jim, thank you for joining us for this segment of the Options Playbook. Appreciate it. While wrapping up today's market domination, don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for Market Domination Overtime.